Okay, on to one of my favorite parts of what we do here at New Era Investing, and what we're very excited to teach you guys are creativity in terms of your lending, but also better understanding the deal costs associated when you fix and flip a project. So let's get started. So we'll start off here with types of lenders. Number one first type of lender is a private lender. When you first start off, private lenders are most typically friends and family in exchange for their money to complete the project, both on the purchase and the rehab, of course. There's two sides that you have to raise on. You can offer them either interest or do a profit share arrangement. Starting with the profit share arrangement, you can simply split the proceeds 50-50 in exchange for the capital to purchase the home and to complete the renovations. An example is that a private lender gives you $300,000 for a project. The total profit on the project is $40K. You split the proceeds 50-50. So you essentially pay them $20,000 in their equity proceeds along with their principal investment of $300,000, and then you keep the $20,000. There is another way to go about offering returns to those private lenders, to those private investors, which is going to be on the debt or the interest. Here at New Era, we are most familiar going this route. We found it to be more advantageous going this route. One of the major reasons there is when you're offering on the interest or you're offering on the debt, it can become more of a fixed cost because you know what the interest rate is, and you can at least forecast how long you'll be borrowing their money for. Thus, you can more accurately estimate what you're going to make on the deal. So, private lending on the interest, offering to borrow their money at a certain interest rate, generally between 10 and 12% annually, or 0.83 to 1% a month. Keeping one thing in mind, the interest rates of 10 to 12%, when it's communicated that way, it will be over a year. So if you don't use that money for a year and you return principal prior to, you do not pay the full annual interest. Rather, you just pay for as long as you held the money. So if you're at 12% annual interest annually and your flip cycle takes 6 months, you will owe 6% interest in that scenario. An example here, same example as the top. A private lender gives you $300,000 for a project at a 12% interest rate, annual interest rate. The project takes you 4 months. You then pay them $12K in interest plus their principal investment, and you keep the rest. So as you see in both those examples there, the interest option yielded you a greater return. Looking at it there again over 4 months, so it's at 12% annual rate, which is about 1% a month. For 4 months, it's 4%. At $300,000, 1% being $3,000 times 4, $12,000 in interest. So when you're starting, however, here's the major question about this. This is obviously would be great, but when you're starting, it can be challenging to find individuals who not only have $300,000 liquid available at the time, but also trust you enough to allow to invest that amount with you. It's something personal. It is a lot of money for when you're starting off for one person to invest. So in our trajectory, in our career at New Era, this was not something that was readily available to us off the bat. It came with time. All right, so now the most common source of financing for first-time, even experienced fix and flippers. These are, which many of you have probably heard of, these are hard money lenders. Hard money lenders are a very common source of financing for the investors. They're very easy to find. There's a lot of them out there. It would take a lot less effort to find these guys than it would to find the individual who has $300,000 available, private lender wise, that is confident enough to invest in your deal. Generally, hard money lenders, they provide financing primarily based on the value of the property being purchased rather than the borrower's creditworthiness or financial history. This is because the property serves as collateral, so it's a recourse loan. And if the borrower defaults, the hard money lender can sell the property themselves, minimizing the risk of loss. Okay, let's unpack that a little bit. To give a good example, this is a little different than if you were to get qualified for a conventional loan buying your current primary residence. There was your mortgage lender required a bunch of information from you: pay stubs, bank accounts in the last 3 months, your credit. A lot of factors went into that in terms of that lender lending on the product on the property. This is a little different. These guys are lending off the opportunity. The better the opportunity, the greater leverage you're going to get. These guys also know that if you default or if you're unable to make your payments, they're gonna lend at a certain percentage that they can take. If you default, they can take control of the asset, and they're very experienced in disposing it very quickly. So they're okay with taking the risk. Now, there are still requirements for these hard money lenders. They're not just going to blindly lend to you. They'll have a couple of requirements in terms of your credit and also in terms of your liquidity. As mentioned here, some hard money lenders may, however, require borrowers to have a certain percentage of liquidity based on the loan amount. If you don't have the necessary liquidity in your bank account, you might need to bring on a sponsor or someone who can JV the deal, who has the demonstrated liquidity available. The liquidity that they're needing, they want to make sure you can make your monthly interest payments. They don't want to lend to you if you're unable to make your interest payments on the loan. So what they're going to do is to ensure that you have the liquidity available. That's why specifically I'm mentioning liquidity based on the loan amount, because the higher the loan amount, the greater the liquidity requirement will be. Now, they're typical terms from hard money lenders. These guys are going to be expensive, but they're meant for a specific purpose. They're meant for velocity. They're meant for people who can come in, borrow the money, forcefully appreciate the asset, get that back on the market, and get it sold in a shorter period of time. And they're very advantageous for that type of borrower, which is a fix and flipper. They're usually funding between 70 and 90% of your cost. So your cost is your purchase price and your rehab cost, your total project cost. These guys are going to come in 70 to 90% loan to cost. They can close within 7 to 21 days. So you can either quick close, they may require appraisals, things like that, which are annoying, but there's no way around it until you show experience. Then you hit us up and we'll introduce you to one of our guys who will never require that. But in starting off, these guys are going to ask for appraisals to ensure that the value is there at the home. So they're lending just a portion of that. They're going to offer annual interest rates between 8 and 15%, and you're going to make it on a monthly interest only schedule. So, if it's, call it 12%, that would be your borrowing at about 1% a month. So every month you hold it, it's an extra percent. And then at the end of the term, there'll be a balloon payment of the principal amount. They're going to charge a loan origination fee, 1 to 3% of the loan value. So again, these guys are going to be expensive. On top of that, they're going to have additional fees. They're going to have processing fees, appraisal fees, underwriting fees, other admin fees. You're going to see some bullshit fees. You're going to be like, what the fuck am I paying for? But this is the service you get. You get the convenience, but you pay for it, which is very normal in real estate. So this is kind of in the example of the most typical type of way you finance your deal, which is via a hard money lender. Now, I had mentioned, they're going to lend 70, 90% of the cost. So specifically, that's called loan to cost. Some lenders are going to do loan to value, and I can get into that in a later module, but I'm just going to talk about loan to cost for now. The loan to cost ratio compares a loan amount to the actual cost incurred to purchase and to renovate the project. So it's the loan amount versus the total project cost. Total project cost is your purchase price plus rehab. The loan amount divided by total project cost, that's your leverage. So for example, if you were to, if the total cost to buy and renovate a property is $150, the lender offering 80% loan to cost would lend about $120, meaning you're gonna have to come $30K for down payment plus closing costs. So that's obviously a little bit better than the $300,000, or this example would be the 100, and instead of coming in 150,000, you're now just coming in the 30,000 as a down payment plus closing costs. But what if you don't have the necessary, liquidity available to afford that? Then you go to this syndicated combo, which New Era regularly practices. Basically, what this combo is you take the first position lender, hard money. They're going to give you 70-90% loan to cost. You're going to get the first position from them. Then you're going to raise the second position. You're going to raise the gap. You're going to raise what you're required to come down with from private money. It is a lot easier to raise $30,000 than it is to raise $150,000, $200,000, $300,000. More people than you probably know have that available, 30 to 50,000. So it's in abundance. This kind of a range, this amount. This is really when New Era hit its stride, when we figured out that like this $30,000 to $50,000 investment was very achievable, and it's always a number we were looking to get that gap amount in and around. So, for example, the total cost, that same example from before. So the total cost to buy and renovate a property is $150. Lenders offering 80% loan to cost. They're going to lend $120. You got to come $30,000 the down payment plus closing costs. So what you'll do then is you'll go and you'll raise that down payment from private money. It's a lot easier again to raise $30,000 than to raise $350,000 to $300,000. The $30,000, otherwise known as gap funding or second position financing. These are the terms you're going to hear like more regularly from, I guess, those savvy investors. We're calling them gap funding or second position financing. So what does that mean? If it's second position financing, what does that exactly mean? So in the case of a default, second position financiers are paid after the first position lender. So they're lower on the capital stack. Therefore, they take on more risk. The first position is going to get their collateral. Second position is going to get paid right after that. So what does that mean? They're going to require a higher interest rate. They don't have the collateral, the security to back it in the first position, rather only in the second position. So you're going to have to offer a more competitive rate. So generally speaking, you're talking between 12 and 20%. Don't be shocked to start above 15, maybe above 18, but it's such a small amount. And instead of putting that capital down yourself, you're raising it and you're only giving, even at 15 to 18%, it's kind of nominal in comparison to the overall profit you should be making on these projects. Now, that being said, I've always said, have a little skin in the game. Our investors love that too. We all have skin in the game. It's not just them. Everybody does. In general, we recommend that you're the operator. So the operator is you, the operator of the project. You invest 2 to 5% of the purchase price into the deal. It's not required. If you can go strictly OPM, you can raise all the money of the total deal, etc. There's no one stopping you. It's a personal recommendation that you have some skin in the game, 2 to 5%. So the question there is, how much of my return has now been diluted because I'm offering even more interest in the second position? So same example. Total cost to buy and renovate a product is $150. Lenders offering 80% loan to cost. That would be $120, meaning you have to bring $30K as a down payment plus closing costs. Okay. If you were to raise 100% of the gap, right, $30,000, and let's say you negotiated 15% annually, and you completed the product in 6 months and you made $40,000, we'll call it gross profit because you haven't paid that interest yet in the second position. We'll call it gross profit, 40K. That means you would have to pay an additional expense to the gap lender of $2,250, right? So it's 15% over 6 months. So it's essentially 7.5% of $30,000, which is $2,250, yielding, meaning your profits, there was a reduction in profit, but you went from $40,000 to $37,750 and you put $0 down. So the decision's yours on how you do this. Again, we recommend have some skin in the game. But once you start to gain traction, this is an option available. You can go 100% OPM. A lot of the guys kind of like on our level, they're all going 100% OPM. So it's a tried and true practice. You just have to be careful getting over leveraged, because that is definitely a reason you will never come back into the space. You will become over leveraged and you're going to have to come out of pocket yourself 5-6 digits even to make sure you don't become over leveraged. Deal costs. what are the costs associated with a fix and flip project? So I kind of want to take a step back and say, okay, now you need to understand all the costs associated. It's not just your down payment, right? There's a lot of fees that go into this, and it's good to. Now, the underwriting spreadsheet is going to have all this for you, but I just like you guys to know what these costs are, so you speak the lingo, you can talk, and you're talking to your investors, you're sophisticated, you know every aspect that goes into it. So cash to close, this is the total amount of money you need to bring to the closing table to finalize the transaction. So we had talked about loan to cost 70 to 90%. There's another rule of thumb here you can use. Down payment 15 to 25% of the purchase price. Generally, it might be lower, it might be higher. This is kind of your range that you're going to be in more times than not. Closing costs at least 2% of the purchase. That's going to include your loan origination charges, your broker fees, your lender fees, your title fees, your appraisal fees, your inspection fees, your attorney fees. I mean, the fees go on and on, especially when you go hard money, go on and on. Private money, you get to that point, these will definitely come down, but right now you throw them all on there. Then you have your mandatory prepaid costs, 2% of the purchase price again. That's going to be your property taxes you got to pay for the next 6 months. Here in Connecticut, we're paying 6 months at a time at once. Property insurance, but also your hard money lenders, including some of the private lenders, they will require you to pay first month's interest only payments. It's kind of like you rent a place and you pay the first and last month rent for deposit, essentially. It's very similar, but they do require that. So your total cash to close, you can budget 20 to 28% of the purchase. That's generally what you're going to need to bring to the table, all in. Again, things will vary, but this is kind of a nice generalization number, so you know what you need to bring in. Now, I will say the underwriting spreadsheet is going to tell you exactly what you have to bring in. When I mean exactly, I mean it's going to be pretty damn close. It's all going to be based on the inputs you put in. So if it's off, it means, more times than not, there was an input that was inputted incorrectly. But generally speaking, 28%. Then the other costs. Okay, so you have ongoing costs as well, right? So, okay, cash to close, great. You paid 20 to 28% of purchase, good. You bought the deal, great. Now what? You're going to have ongoing costs, right? So your regularly monthly interest-only payments. If the product is financed through a loan, which starting off it most likely will be, you will need to make regular monthly interest-only payments, okay? So that's going to happen every single month you hold it, and that'll just be a percentage of the total interest divided by the months. That's pretty much what you're going to be paying every month. Utilities, as you know, power, water, heating, other utility costs incurred while the product is underway. But you also have a reserve or contingency fund. This reserve fund is set aside for exactly that, for a reserve contingency fund. Usually speaking, the way we're coming up with that is we're saying it's going to cover unexpected rehab costs that are incurred during the project. So you should budget 10 to 15% of the total allotted rehab budget for just this contingency fund. And then finally, your other costs. So interestingly enough, the way this goes, right, is the lenders, they're going to credit you for the costs you incur for the rehab up to a certain number that you've already negotiated with them. But you have to make the first payment to the contractor. These guys the lenders are not going to pay you up front to start the project. They are only going to pay you when the property is worth that amount. So if you forcefully appreciate the property X amount, what they're going to do is once you're done, you're going to send them pictures, they're going to do an inspection. They are going to give you that money because now you've proven that the property is now worth that amount. It's not the other way around. So while most lenders offer 100% financing or close to it, for your rehab product, they will require you to start making updates before they release funds back over to you. This means you will have to cover upfront payments for your contractor to start demo. Again, you can start small. You can start a little greater. This will be covered in a never section. You're never going to start at 50%. Ever. You're never, ever going to start at 50%. We learned the hard way. Telling you right now, do not do that. I'd rather you take six payments throughout than go 50% for your first. While it might be a little inconvenient, trust me, there's a reason why we do it that way. For New Era, 3 to 4 at the 3 to 4 range. Again, I'd rather you be at six payments than 2 payments. But these are some of the other costs that are associated with it. And that is essentially how you can go 100% OPM, make healthy profits, and scale the fuck out of this.